what we actually focus on this morning this segment as we speak right now. I'm going to have you on the show. Welcome on the breakfast show on a Tuesday.
Yeah,
It's been a week.
24th June. June has flown, eh?
In fact, not only June, but let's talk about the year itself. The year itself has just flown fast. 2025, wow, it's just something. But yeah, we hope for the best.
We hope we can achieve the rest of our goals.
True.
Yeah, I
In,
hope so.
in the remaining few months.
Yeah, we've got 6 months.
Oh yeah.
Mm.
So it's mine Chilu right here alongside Mukonki at the moment. Want to learn more on the inside,
Mm.
Ndalama Insight right here
Mm.
in government bonds. Very, very, very interesting question there. Okay, that we normally receive questions from different parts of the nation when it comes to this segment here. So today's question is one we've heard from many listeners, okay, which is, can I lose money in government bonds?
Mm.
What is your take on this?
It's a very great question actually, because oftentimes we are told, even I said this several times on this platform, government bonds are secured investment,
Mhm.
your capital is preserved. We don't expect you to lose money when you make an investment in a government bond. So it is something that we often speak about. But it's also important to realize that there are certain times when you can actually lose money. And that is what I would like us to discuss this morning. But before we get started, Chilufya, I think it's important to give a general background and an understanding of what a JRZ bond is for those that are new.
Mhm.
Every time we are on radio, there are always new people that are joining us that have never heard this program before.
True.
So even though we speak about this regularly every week, it's also very important to refresh our memory. So for those that are joining us and that don't know what a JRZ bond is, it is simply when you lend money to the government for a specific period of time, and then the government assures you to pay you interest and to pay you back your full money, the money that you lent to them, when that bond matures. That is what a government bond is. So you are assured of getting your full investment back when the bond
Mhm.
matures, rather. That is guaranteed. But then there are certain situations when you can lose money, and that's what we'd like to look at.
Oh, beautiful. All right. So there are those situations I would want to know. I would want to learn more
Mm.
on those situations. So let's get right to it, Mukonki. Can someone actually lose money? As in which ways can
Mhm.
somebody lose money or lose their buying power?
So there are essentially three ways you can lose money. I'll start with the first one, which is when you sell the bond before it matures.
Mhm.
Because if you want to secure your money, the safest way is to hold on to that bond until it matures. But where you decide to say, I would like to sell this bond on the secondary market. So you bought it from Bank of Zambia in the primary market, and for whatever reason you need cash urgently, you decide to sell your bond on the primary market. So on the secondary market. When you go to the secondary market, you may lose the value of the bond. That is you might recover little less than what you had anticipated to get back if you sell the bond on the secondary market because of changes in the interest rate. Your bond might not be worth as much on the secondary market. So that's the first starting point to understand. So if you don't intend on holding the bond until it matures, there's a risk that you can actually sell it for a lesser price than you had intended to recover if had you held onto this bond until it matured. The second one, which is pretty interesting and is something we are all facing at the moment, is the effect of inflation as well as the withholding tax and handling fee.
Mhm.
So when you are making an investment in whatever investment you are making, you always need to look at the real rate of return on an investment. So there are two types of returns that you can earn on an investment. You can earn a nominal return or a real return. The two are different. So as an investor, it's important to understand these concepts. So a nominal return is like for the government bonds, for example, if you bought a 3-year bond for 10,000 kwacha and the coupon, let's say, is about 15.3% on that 3-year bond, the nominal return is the 15.3%. That is the nominal return. But the real return takes into account any deductions, including inflation and taxes. So what is the real rate of return on this 3-year bond? If it's giving you about 15% coupon rate, or 16.5, I think, somewhere there, and then inflation is at 15.3 currently, what is the real rate of return on this 3-year bond? You need to calculate that. So when you take into consideration the withholding tax and handling fee of 16%, and also take into account inflation, you'll find that the 3-year bond, the 2-year bond, and even the 5-year bond actually give you negative real rates of returns. So something for you to work out when you get to your offices, when you get to your wherever you're going, is actually calculate what the real rate of return on an investment is. And it's very, very simple. Just take into consideration the deductions for the taxes, if an investment has withholding tax on it, and also compare it with the inflation. The difference shows you whether you've got a real rate of return that is positive or not. So what you are looking for is a positive real rate of return, because that shows that your money's purchasing power is preserved. When the inflation is going up, you can still buy the same quantity of goods if your real rate of return is positive. But if it's negative, it means the purchasing power of your money is you're losing the purchasing power of your money if the inflation rate is higher than the real rate of return. So it's very important that you look out to the real rate of return on any investment. Always look for a positive real rate of return. And then the third and final risk that you need to consider, or when you can lose money in a bond, is the reinvestment risk. So yes, you would have made an investment in a 3-year bond and it was perhaps earning you 20% a few years ago, a few months ago. But then when it matures, you would want to reinvest that money into another new bond. Then you find that the current bonds, the 3-year bonds, are actually fetching at lower coupon rates than they used to when you bought the 3-year bond a couple of months or years ago. So that is the reinvestment risk. It means that you do not have the same opportunity to make the interest or coupon that you could have made had the interest rates been better when you are reinvesting. And also just the lack of opportunity for you to reinvest your coupon income. So for those of us that want to spend our coupon incomes when we get them every 6 months, we are losing out on reinvestment, and that can also affect our overall returns that we could have made. We could have earned compounded interest had we reinvested our coupon incomes rather than spending them. So these are the 3 times when you can actually lose money in an investment in a dual-rated bond.
Oh, beautiful, beautiful.
I hope they were clear to you, Chilufya.
I'm learning a lot. I'm learning a lot on the breakfast show right here. Okay, and then I just love the fact that just the breakdown is really helpful there, given these factors, especially the negative real returns on social bonds you mentioned. Now, what should listeners out there do if they already hold a bond that's losing purchasing power, or let's say if they are considering buying new bonds like today?
This is very important because majority of us are holding bonds and then we are seeing the coupon rates coming down. For a couple of months now, we've seen coupon rates on all the tenures of bonds that we have. In Zambia, we've got 2, 3, 5, 7, and 10 and 15-year bonds. So for existing bonds, their recommendation is that you hold on to that bond until it matures, particularly if it's nearing maturity. So it's recommended that you hold on to that bond until it matures, because that assures you of getting your money back rather than considering selling it. So try to hold it on until it matures. For new bonds, if you are making a decision today whether you should invest in a government bond or not, you need to consider bonds that will give you a positive real rate of return. So that requires you to take into consideration the withholding tax and handling fee that I just spoke about, and then comparing that return with the inflation. If the difference will give you a positive return, that is the kind of investment you want to put your money on, because it assures you that your purchasing power of your kwachas are preserved. And so target positive real rate of returns. And at the moment, it is the longer term bonds that are giving us positive real rates of returns. I did the computations yesterday, and what I discovered, Chilufya, is that all our short and medium term loans, so GRZ bonds, are actually giving us negative real rates of returns we are losing the purchasing power. If you're buying a 2-year bond, 3-year, a 5-year bond, it's losing the purchasing power. If you want to preserve the purchasing power, you need to invest in longer term bonds. Perhaps consider 10, 15. Those are the ones that are giving us a slightly positive real rate of return. The other consideration is diversifying your investment. So we need to understand the role of a bond. Each investment in your portfolio has got a specific purpose that it plays. The purpose of bonds basically are for capital preservation and for you to attain specific goals. So a second consideration is consider diversifying your investments outside bonds alone. So for those of us that have been really excited about bonds in the past, we also need to start venturing out, considering other investments like shares and property that can actually beat inflation. So it is not, you are not tied into just this one investment. You can also consider other investments. And finally, when you are buying an investment, always match it with your financial goals. That is where you now come back and look at the desirability of the GRZ bonds. For your financial goals, are they helping me achieve a certain goal? Perhaps you want to send your child to university and you know the fixed amount and you don't want it to depreciate in value. Let's say you've decided that I'm going to spend 100,000 kwacha on my child's university fees in the next 3 years. So you could buy the GRZ bonds because you, in terms of the nominal value, the actual kwachas, you get back your 100,000 back. And that is what we call capital preservation. So always match your investment with your financial goals and understand the specific purpose of each investment.
Oh, beautiful. Oh yeah, what a show that's been this one. So in closing, your take home message, give us some tips. Give us Zambian tips considering investing, in government bonds. What would be those tips that you give?
So the tips I would like to give, I know for those of us that invested around 2023, even prior years, we were enjoying very good returns on GRZ bonds. Some of us invested in 15-year bonds where we're getting 27.7%. Now a 15-year bond is fetching at 20%. So it can be disheartening, but I want to tell you that don't despair, because GRZ bonds still remain a secure and safe investment as long as you understand the function that it's playing. So here are the 5 tips that you need to think about as you are buying these bonds. Invest with a purpose. Know why you're buying the bond. Is it for income, a regular income? Is it for a specific goal that you want to achieve in future and you want to use that money? Also, consider holding to maturity if you can, so that you recoup the capital value of your money. Target positive returns. This is very, very important. Target positive returns, particularly if you are buying the bonds today. Always consider the tax and compare it with the inflation rate so that you buy bonds that give you a positive real rate of return. And finally, consider reinvesting your coupon incomes. It might be difficult, but that is how you benefit from compound interest. So consider reinvesting your returns, that is your coupon incomes. It doesn't have to be in bonds, it can be in other investments like shares. So if you get maybe a 6-month coupon income of 15,000, 20,000, you can also consider buying shares with those coupon incomes. That way you're also diversifying your investment. So these are the few tips that you need to consider.
Oh, nice. Mukonki, it was good having you on the show. It's always good having you on the show.
It's always great being here, Chilufya. I really appreciate being here. And I would like to say good morning to those that are online. Is Mr. Edwin Zulu. I don't know if it's the one that I know.
Okay.
Mr. Edwin Zulu, I see you. And thank you so much for saying that it was a good topic.
Nice.
Then there's also Katongo saying, what would make you sell a GRZ bond before it matures? Perhaps we've got a minute before we run out of our time. Maybe I can answer this question. What would make you sell a GRZ bond before it matures? A number of reasons. One of the reasons could be that you want cash. You've got an emergency. You didn't anticipate, a certain turnout in your life, as we call them, vicissitudes of life. Suddenly problems are popping up and you want to sell your bond. So a number of reasons why you would sell the bond. One of them could be emergencies, and you need the money, you need to recover the money. So you need somebody to buy that bond off you. Then you go to the secondary market. So that's one reason. In addition to also the fact that you could actually make a profit by selling the bond on the secondary market. That's another reason why people sell bonds on the secondary market. You may be holding a very valuable bond. Like I said, some investors have got bonds that are giving them coupon incomes of about 27.7%. That's very valuable. If they decide to sell the bonds today, imagine to somebody, someone can be getting coupon incomes at a rate of 27.7% compared to the 20% on the 15-year bond. So it means that the one that holds that bond of 27.7 as a very valuable bond. So that's another reason why they could sell the bond.
Nice. Wow. Mukonki, all the best.
Thank you so much, and good morning, everyone. We'll see you next week.
And have a great day.
Thanks.
So that was Mukonki Mukonkela there, financial, and business advisor from, Insight Partners there. Okay, in the Ndalama Insight, as usual, every Tuesdays we give you more information, and